What's up, Central Pennsylvania? This week we're going to talk to you about a 15-year refinance and how this can save you a ton of money over the life of the loan. Now, a lot of people don't know this, but there's a huge difference, generally speaking, between a 30-year fixed interest rate and a 15-year fixed interest rate. The 30-year fixed interest rate sometimes is as much as a point or half a point higher than the 15-year fixed interest rate. And the way that these loans are amortized, you tend to pay a significant amount more interest on that 30-year loan because you're paying it back over a longer payment reschedule. I'm going to take a little bit deeper dive so you can kind of see how the math works on this, but shifting a lot of times from a 30-year loan to a 15-year loan could save you $100,000. And I think when I start saying numbers like that, people are like, maybe I need to listen to this. If you take a 30-year loan at $220,000 at a rate of 3.375, and I'm just using this for like estimation purposes, your payment's going to be about $972 principal and interest, okay? With that loan, if you pay the minimum payment for the duration of the loan, you're going to pay about $130,000 back to the bank in interest over the life of the loan. And for the first 10, 15, 20 years, you're really not going to make a whole lot of headway on that loan because those loans are front-end loaded with interest, meaning if you're paying your $972 payment, probably this much of the $972 is going towards the bank's pocket in the beginning of the loan. On the other side, if you do a 15-year loan, the same loan amount, $220,000 at a rate of 2.5%, your payment's going to be around $1,477, and here's the staggering number, you're only going to pay the bank back about $44,000 in interest over the life of that loan. Not to mention the fact, if you're only in the home for a period of time, 5, 6, 7 years, the amount that you're going to owe the bank when you sell the home is going to be substantially less than if you were on that 30-year track, because the 15-year loans are front-loaded with principal right out the gate, meaning majority of what you're paying is principal, not interest. The difference in payment that you're going to make is about $500 more a month. It's in the high fours, okay? Meaning it's like $497. But by paying that little bit of extra every month, it's going to put you in a much better financial situation where you're going to be mortgage free in 15 years. For a lot of people, that's 3 or 4 dinners out and maybe spending $100 less on Amazon every month, and they have the full capability to do it. They've just got to kind of make themselves have a little bit better discipline. So think about how being mortgage free in 15 years versus 30 years can impact you from a retirement perspective. And if you have additional questions, reach out to me. I'm happy to take a deeper dive into your personal situation. And just remember, these numbers were given as guesstimation purposes. The market's constantly moving up or down. This stuff changes daily. As always, check us out at yourpamortgage.com. We're happy to help.